Welcome, everyone. It's my pleasure to have you here and welcome you to CSV's Shop Talk featuring Anamitra Banerji and sponsored by the Cornell West Coast Alumni Affairs and Development Team and Cornell Silicon Valley. We thank you for joining us. My name is Ashley Binter, and I am a member of the Alumni Affairs and Development Team for the SC Johnson College of Business. So that includes the hotel school, Dyson, which was agricultural economics for a long time within CALS, and the SC Johnson Graduate School of Business. Our goal today and every day is to enhance and build connections all along the West Coast. And so we're extremely happy to have Anamitra joining us today and sharing his wisdom and expertise. Anamitra earned his undergraduate degree in India and then came to the SC Johnson Graduate School of Management and earned his MBA in 2004. Following roles at Overture and Yahoo, Anamitra became the first product manager at Twitter. From there, Anamitra moved on to Foundation Capital as a partner and launched Afore Capital in 2016, where he serves as managing partner. Afore is a $124 million venture fund focused on pre-seed stage startups. He enjoys the process of working with entrepreneurs to take interesting technology or ideas and transform them into features, products, or in Twitter's case, a business. Anamitra feels lucky that he gets to work with the smartest people in tech on solving fundamental problems, learning from them, and contributing to their success. So without further ado, Anamitra, I don't know if you want to say a few words of welcome, and then we'll get into the questions.
For sure. First of all, I'm Anamitra. Hi, everybody. Thank you to Ashley, Nancy, and Kate for having me here, and to Cornell for having me here. This is a lot of fun. The few occasions or the few chances I've had to go back to campus to visit, I deeply enjoy. I graduated a long time ago. I graduated in 2004. My parents couldn't make it to graduation. I think it was Bill Clinton, I think, who actually spoke in our year. But wow. They did get to come. They did get to come last year. We took the family out to visit because my brother went to the Johnson School also a few years after me. And the Cornell, I'm sure, has played an important role in a lot of people's lives. But for mine especially, I was just, I don't know how, but I think Cornell took a chance on me in 2002, sent me, back then they used to send acceptance letters over email, and I'd been sort of passed on by a number of places, and I was expecting to open that email and then go right back and then try again next year. But I think they must have made a mistake. They started with congratulations instead of unfortunately. I said, I got to reread this. I had my parents reread it, and it turned out, and I called to make sure it wasn't a mistake by any chance. And but it wasn't, and I came to Cornell straight from Bombay in 2002, which was a sweltering August into a generally nice generally nice fall. But I was writing letters back to my parents back home in India at the time, saying, this is a beautiful, beautiful country. I'd never been to the U.S. before. It's a beautiful town of Ithaca. And when snow first started falling in October, I'd never seen snow before, and it was the best thing I'd ever seen. I would write even more letters, and then the third day of snow, I was like, this is enough. Like I don't know what's going on. When will this thing stop? This is too much snow. I got to shovel my car out of the driveway. But it was a fun 2 years, and it was Cornell again who came through for me when I was looking for a job in my coming out of my second year there. If immigration is hard now, it's way harder now, but it was not great back in 2004 either, because there were not a lot of companies willing to hire someone with an H-1B visa sponsored, and most companies didn't even know about that. But the tech companies did. The tech companies couldn't care less. They wanted to bring anybody else on board, and it was another alumni, Will Johnson, who also graduated from Cornell. I had used the alumni database to cold email anyone I could working in tech from Seattle to San Diego, and Will was kind enough to forward my email to a hiring manager at a company called Overture in LA, another city I had never been to. Turns out that was a lucky move because Overture had invented paid search advertising at a time when Google was running banner ads. And Overture was looking for someone to work on product and business and other things to sort of to monetize that even better. And I lucked out there second time. So Cornell played two important roles in getting me to the States for the first time, and then second, getting me my first job. And then since then, it's been mostly in tech, almost entirely. And then now, having worked at companies building software, I am in a fortunate place where I get to work on not one product at a time, but work with a number of founders working on a number of products simultaneously. And that job description is venture capital, as it turns out. I like the venture part more than the capital part. And then that's what I'm practicing now in Silicon Valley. The last sort of 7-8 years has been in the business of venture, which is just going through a resurgence right now.
That's great. Thank you so much. And you took my first question, which was, how has Cornell impacted your life? Because we're alumni affairs and development people, so we love asking that question. But can you share a little bit about, after Overture and your move to Yahoo, what made you move on to Twitter? I find that I think that's a really neat story. I would love to hear more.
Yeah, great question. So this was in 2006 or so. And the internet, from my perspective, had gone from these sort of portals, AOL, walled gardens of AOL, and Yahoo to some degree, and MSN. Microsoft had something, and people, consumers, didn't start their day on the portals anymore. It wasn't news, finance, and just like the way the newspapers were. The consumers were beginning to go to places like Google more and more often. Information that they were getting was coming through search engines, and that's the trend that Overture rode. And then as we were going through that process, there was another wave in 2004 with Facebook, and then in 2006 with Twitter. And I think for me, it kind of triggered in 2007, 2008 when there was a terrorist attack in Bombay, in my hometown, and I wanted more and more information as fast as I could get it. I turned on CNN, but CNN was showing hours delayed information, and then I went to the web and I looked at all the Indian websites, and they too were delayed. And then from some website or other, they had a photo of one of the snipers from across the balcony of one of the hotels that was undergoing the attack. And I clicked on that link and I went to this new website, and it was Twitter. And then I clicked on something called trending, and Bombay was trending for some reason. This was Thanksgiving. And then I got to see the deluge of information that was coming through from eyewitnesses in a way that information was being sort of generated in Bombay half a world away, and I was seeing it instantly without any filter. No CNN, no newspapers, no editors, no one in between. And I felt that was amazing. And turns out that that was just the beginning of a lot of people's understanding of how fast information can travel in today's world. And that kind of opened my eyes, I guess, to a next trend where information seeks to be free, it seeks to be open, it seeks to move really fast, and whoever can make those connections can do it really well. So I kind of cold called my way to an interview in Twitter in 2008, I think. Actually, I was working at Yahoo at the time, and Yahoo was considering acquiring Twitter. And so the corporate development team, there was a guy there, it was a friend of mine. I said, hey, I don't think you guys will be able to acquire, but if in case you don't, just would you mind slipping in my resume as you walk out? I don't know if he did that or not, but I got a call, so I went back and met the team, and I was fortunate enough to join the company. That was late 2008, early 2009.
That's incredible. Oh, I love that you were a user before you started there. That's a really great story. And
yeah.
Oh, go ahead.
No, I was just going to say, I think that's one of the things that I realized Twitter looked for. And not just Twitter, I think all early stage technology companies tend to look for, to the extent that they are consumer companies, they look for folks who have an opinion and they have experienced it and they're willing to take the risk and they have a bunch of ideas about what to do differently or better and so on and so forth. And I think that many of these folks play a pretty substantial role in what happens, the direction that some of these companies go eventually. First 100 people at a number of companies have kind of interesting sort of experiences, the stories they have, and certainly the stories we had. At I think my first week, the governor, Schwarzenegger, he rolled into the Twitter headquarters. They shut down a block around us. He brought in canines, and we were just sitting at our desk, and Arnold just walks past. I was thinking of giving him the Terminator, "I'll be back," something like that. But it was a fun time. Gavin Newsom showed up. We had celebrities line up wanting to get into the office. It was an interesting place to be early on. I think Medvedev, the Russian prime minister at the time, came to the office, and Twitter was going through some troubles at the time, mostly on the tech, because we couldn't keep the website up for long periods. And this was the first time a Russian government official would use Twitter to push out a tweet, but Twitter wasn't working. So they erected overnight a fake twitter.com just so that he could hit the button and a tweet would go out. And his security detail had a number of security concerns. So they wanted all our blinds down. They positioned snipers in all the buildings around us. There was an airport security downstairs. We didn't even have badges at the time at the company. And there was a whole gaggle of Russian journalists following him around everywhere. We had Snoop Dogg come in once, and I think he got everybody excited. It was lunchtime. I think all the executives were out, and Snoop Dogg lit something up, and the fire police. Some stuff happened. Anyway, it was a fun place. Lots of experiences.
That's amazing. I love that. And by the way, Lydia said, one of our participants said, that was my catalyst for joining Twitter as well. I think she has a similar story as you. So you're at Twitter and you make this decision to move into venture capital. So were you already advising startups at that point? Is that what moved you, or what caused that move?
Yeah, I didn't know much about venture capital when I was at Twitter, or before that I had no idea. But origin stories always interest me. Like, how do things get started? Because I think it's kind of who started them, how did they get started? Because in the beginning, most people tend to be non-believers, except for just a handful of people. And whatever you start, because it's easier and more obvious to come up with a long list of things why certain things won't work as opposed to why they will work. And you kind of need an irrational, exuberant person to say, nevertheless, I think I'm going to try this. So I've always been generally sort of fascinated, curious about being the first to know, wanting to get in early, and curious about people who start things early. So there was a lot of those types of people at Twitter at the time, and there were some of those folks were venture capitalists. They would walk the halls at Twitter, people who had invested in Twitter very early seed stage and Series A stage and Series B stage. They would help a bunch of folks at Twitter, and I got to know some of them through meetings and to get to know them. That's how I first learned about venture capitalists as an industry. And then it wasn't until I left Twitter that I got to see it that I got a better glimpse of it. Because when you're working at a place like Twitter or any other place, like if you take companies today, like Segment and a whole host of other companies, you have tunnel vision because you have a priority and a goal, and you want to hit that goal. There are 20,000 things to do. You can only do 2, and that's the entirety of your focus is just that. You don't think too much about what is going on in the world outside of that. And I think after I transitioned out of Twitter, I realized that while Twitter was starting, there were also companies like Airbnb and Uber and Dropbox and a host of other companies that were working on completely different areas that were also beginning to take off and innovating in areas that I hadn't thought about. And I think venture is a great sort of a next step after having been working at one company for a long time, because it gives you the time to look at what else is available, who is working on other interesting problems. And one way that venture funds do this very successfully is they have these programs called the Entrepreneur in Residence programs. They're called EIRs. EIRs are just vehicles by which VC funds get to build new relationships with people who are leaving a set of companies that they're excited about, in the odd chance that these people might work on something else that the fund would invest in. And so I got invited to join an EIR program, which I didn't know about prior, but I did like the venture offices. They were amazing. So I thought it's not bad. After going deskless at Twitter for a year and a half. In fact, my wife once complained when she was visiting me at Twitter, she found our wedding photo in someone else's desk. Turns out that we had moved desk and I forgot to take all my belongings, and that happened.
Oh no.
Yeah, she still remembers that. Going from there to a venture office, which to the extent that some of you might have seen it, they're very nice, glitzy places where they have placemats for lunch and they bring you silverware to dig into your hamburger, and they have it's like a proper office. So I said, not bad. After going deskless and with just my iPad and computer to having a real office place, and then what they do is they roll in startups on Mondays and Tuesdays and Wednesdays, and these startups talk about how they're changing the world. I found that to be really inspiring, and they're working on all sorts of different areas that I had no clue about. I learned a lot, and that's essentially my initiation process into venture, to see, what was this life like? What did they do? From a intellectually curious perspective, which I think I am, it's a great experience to see other ideas that other people are working on, which could become really, really big over time. And you thought that Twitter was the center of the universe. Turns out not to be true. There are a whole host of other things that are equally bigger, or could be even larger than what Twitter is working on.
And so when I'm going to ask one more question, then I'm going to open it up unless anyone has a burning question they want to ask Anamitra, and Anamitra will be back. His video.
Yep, I'm here.
He's here. So, okay, I'm going to keep going, but please think of some questions, everyone. We are hoping this can be a dialogue conversation. So you're at Foundation and you want to launch your own venture in Afore. And so how was that transition to move into, were you doing fundraising at Foundation? And so like, how did that sit with you? And then also, the focus on pre-traction, pre-revenue, pre-product, how did you arrive there? And what size investments were you making in companies, or are you making?
Yeah, and to the extent that folks know early stage venture, this might seem boring, but I'll give you a quick sort of primer. So venture capital is all about risk taking on technology companies and giving them enough capital to get to a milestone where so it's milestone based financing pretty much. And historically, it starts with the very first raise that anyone does, and it's a relatively nascent or new industry relative to other sort of asset classes like private equity and so on. Historically, this stage has been dominated by very well-known Series A funds. Those funds write anywhere from $5 to $25 million check sizes to get companies. They tend to be their first institutional investor. That had been the trend for the longest time until 2010, where a group of folks who were angels, they called themselves super angels, and decided to say, you know what, Series A investors want to see a lot of revenue before they would invest. Why don't we do something earlier? Why don't we do something called seed, where we will just seed these people, and we would write $500K checks or $2 million checks or very smaller check sizes to get them off the ground. And at that time, they were frowned upon by the establishment and saying like that's like buying a lottery ticket. Why would you invest there? Turned out to be that those funds that did it became extremely successful. funds like First Round, Floodgate, and a whole host of others. But as these funds became more and more successful, they began to raise larger and larger funds. So they went from $25, $50 million funds to $250 million fund, $300 million fund. And usually when you raise large funds, you have to write larger checks. And so when you write larger checks, what that basically means that if you see two companies, one company that already has revenue and is making a lot of progress, and another company that is just starting, no revenue, no traction, just an idea, it is easier to deploy a larger check into the first company as opposed to the second company. So their own success led them to writing larger checks into companies that had progressed further and further, which is what we began to see in 2015 or so. And we realized that at the same time, the cost of starting a company is getting lower and lower, because you don't have to buy your own mainframe. You don't have to buy your own servers. You don't have to have an office even. You can rent everything off of Amazon and you can get started. And even that, Amazon would give you credit. So you like literally to start a company, you need no more than a few $100,000. So we said, if the cost is declining and it's cheaper than ever to start a company, and if the available capital to them, it's the folks who usually invest in those rounds are saying, come back to me when you have some traction, come back to me when you have some revenue. We thought that was an opportunity that we could fill. And so we could go to these very, very early stage companies and say to them, with one check, investment from us, your fundraising journey will be over for now. So you take this money, go back to building the product, and think about a fundraising maybe in a year, 2 years time. With maybe you can raise a Series A, maybe you can raise whatever round in between if you want. And that seemed to be an interesting sort of proposition for many founders. But we couldn't call that the seed round, even though that truly was the true seed round, because funds that had made a name for themselves in seed weren't gonna give it up. So we said we have to come up with a new name. So we're not very imaginative. So we came up with pre-seed. Actually, it was a term that was already in use. And we said, we're going to just call this the pre-seed round, and we're going to celebrate this. And we're going to educate founders that they have this option, this massive option where they can raise $1 million without any traction, any revenue, and then we would do a majority of it, so that they can go right back to building the product and aim to go as fast as they can after us. So that was the message in 2016. We raised our first fund. We had neither of us had raised any venture fund from LPs before that experience, and that was quite a journey. And then we raised a second fund last year, and here we are.
Oh, that's awesome. That's such a great story, and I appreciated the history and the insight there. We have a question from an attendee that's similar to a question in our poll of, what are you looking for in a company? And the question from the attendee, Jitin, is, what are the key things you look for in a product or investment before writing a check?
Hey, Jitin, thanks for the question. So historically, what funds look for when they invest in a company is sort of three things. You have like a solid founding team. Maybe you have a layer of management also, like a head of engineering or a head of sales. The second thing that folks look for is a product that is live. It's being used by customers or people. And the third thing is there is some proof points that this product is taking off, or what we call in the industry product market fit, meaning that this product should exist and people want it. It's kind of like an obvious thing, but people look for that. And usually the proxy for that is revenue. Are you doing revenue or not? Are you selling this product or not? Now, at the stage at which we invest, none of these three things are true, which is the product may be half-baked, or it might be an idea. Though there's no revenue because the market has yet to be proven. And there's nothing outside of the founders. There's no one else. It's just their idea and them. That's it. So question is, what due diligence, really? Is there anything to diligence? So that's and the answer to that is there is actually plenty to diligence. And I'll give you some historical perspective before that. Normally, if you bring the Series A diligence lens onto a company at this stage, more than likely you'll miss the company. And many people missed Amazon when Jeff Bezos was raising his first $1 million. And I think he's on record to say that he met with 60 investors before anyone invested. Airbnb sold about 15% of their company for $1 million or so. The very earliest round at Twitter, Uber and Lyft were done at 5 million-ish valuation. So very, very early. Repeatedly, what has been true is that if you apply the wrong lens, then you're going to miss it. Snapchat's first round was only $450,000. Hard to imagine that being what $20-30 billion company today. So we knew that we had to use a different lens to look at these companies, and I think that's where I think our backgrounds played a role. Both my co-founder Gaurav and I are engineers by training, and then we were product managers, and we were part of the 0 to 1 journeys at places like Twitter, and in Gaurav's case at Android, where we've seen what it's like to build something out of nothing, to invent a product and to put a team around that product, and to identify pilot users or pilot customers who are willing to take risk on a bumpy product. I think those are the things that we look for when we invest, which is the founder coming out of an authentic experience? Usually the telltale signs are the founder has worked at Amazon, and they are seeing the emergence of telephony, the role that apps will play, and they want to build an API so that apps can connect with phones. That was Jeff Lawson's idea at Twilio. And usually these founders have been tweaking on this idea on the side while they're in their main job. They're prototyping something. They can't get rid of this idea. They're participating in hackathons. And they usually, in today's day and age, they usually have something that they can show you. It's not just a drawing, it's a prototype. And when you talk to them, you realize that they've given this a lot of thought. They've thought through all the other alternative features they could have built, but they've chose these set of features. And why have they chosen that? So you can basically go down deep in a discussion with them about their choices that they've made, why they think this is superior to anything else that exists. It's basically, you keep asking why until you hit rock bottom. And that tells you that they've done a whole host of thinking. And then on the other side, you kind of, we look for the same kind of questioning style when we try to understand the market. Who will use it? Why will they use it? What are the alternatives? Why will this feature win? And then we ask some of these potential customers ahead of time to say, would you use it if it comes? And then so on and so forth. So we combine diligence work on the company's ability to build a product, and then diligence work on the customer to see if they build it, will they come? And then we take a risk. And and say, we're not going to write a small check. We're not going to write a $10,000, $25,000 check, but we're willing to write $1 million check and do the entirety of the round because we believe that maybe the first feature won't work, but the second feature won't work. But we think you're in the right zip code of the idea and the market, and we'll take some tweaking to get there. But we think you can. So and then we invest.
Are there any things that you've seen that are common missteps or lead to failure in new startups?
The list is too long. It literally is, but it turns out that companies make mistakes all the time, and despite that, they somehow succeed. We've seen companies where founders are broken up, founders have argued, and then the company still rises above the noise. The one thing that seems to overcome all sort of drawbacks is the market pull. As in, if you've hit upon an idea and you've got the timing right and got a lot of luck, then you get pulled into the market, and customers and users are willing to overlook issues. Just like Twitter had, for example, back then. Like we couldn't even stand up our website, but yet Medvedev came down all the way to press a button. It's that tells you that there's something going well, and then that's really hard to replicate. That's really hard to get, and then that will overcome pretty much a whole host of other short-term issues. Many of those are fixable by replacing people or or changing strategy or things like that. But the telltale signs are, like, no matter how well you execute, no matter how well you build, nobody wants what you're building. I think that's like priority zero error. It's hard to recover, and that's the reason why some investors don't like to take market risk. They don't like to take market timing risk because they don't know whether it will happen. And we've seen in recent years, crypto or Bitcoin going through that, virtual reality going through that, augmented reality going through that. At the same time, anyone working in SaaS suddenly is killing it. So it's like timing is out of most people's control. Investing too early before a trend is hard. And that's why we tend to be very much more sort of micro focused as opposed to macro focused. I'll explain what I mean by that. Usually funds have this thesis. Sometimes there's a nice way to say it. They have a prepared mind on an industry. Let's take HR, for example. There's someone at the fund who's done deep thinking and has published a paper that says, here's what's going to happen in HR technology 10, 20 years out. And hence we will invest in these types of companies. And it works for a number of funds. We are violently anti-prepared mind. We don't want to be the thought leaders in any category. We want the founders to be the thought leaders in any category. What we want to identify is a phenomenon that they're describing, that only they can describe, that only they know about, which should work in the short term. They've identified this micro trend. We don't know if it's a macro trend yet or not, but in the short term, we think this is going to get out of the block. We think they're going to get a start. We think there's a good chance that this is going to take off. In the long run, we don't know. In a way, we're all dead in the long run. So what does matter is what happens in the short run. If you succeed in the short run, then there's a chance it might take off in the long run. So we've kind of flipped the model for ourselves in that way, where we are looking granularly bottom up about, is this going to take off in the first 6 months or so?
Yeah. Well, I'm nervous about my next question. And Lydia, I just want you to know, I do see your question. I can't, as a fundraiser, I love going to get to it, but I want to ask this next question because you just spoke about micro trends. So at the risk of sounding inane now, what are you thinking are investment sectors that might be promising, and even if that's a micro trend?
I'm not sure. There's some obvious ones, things I will say everybody knows about. Do I have any penetrating insights? I'm not sure, but just in the micro, the bottom up phenomenon we're seeing from having invested now in about 50 or so companies, things that are interesting, things that founders are telling us that their customers are telling them, which may or may not be obvious to everybody else. So one thing is, you know how software, I like to be a student of software, and if you study how software has progressed over time, it used to be that someone from a consulting firm or someone would come in with shrink wrap software, install the software on-prem, in your premises, on desktops with floppy disks and stuff, and that might have gone to USB sticks, etc. And that was great, but the problem with that was if you needed to make a change, you need to ship around the floppy disk, and that would take time, and so on and so forth. So software delivery model has moved from that model to a SaaS model where the software is always live on a cloud. And I think most people's first experience of that was Gmail. When you open up Gmail back in 2004, 2005, it just whatever updates they made internally, you will just see all the great features. And that has gone from consumer to now businesses use SaaS all the time. Software as a service, Salesforce pioneered that. And increasingly, I think people are beginning to ask, at least our portfolio companies are beginning to ask, like if a SaaS software is all about surfacing some information to a user such that the information can click a few buttons and make a decision, can that decision-making process be automated also? Such that there doesn't need to be a SaaS website of any kind, where could you teach machines to make that decision instead of human beings, take the learnings from human beings and put it into the machine. And that means that software needs to look different, it needs to be delivered in a different way. It needs to maybe go from a user experience, or UI as we call it, from a website to an API, an application programming interface. So basically an API is not visible to the user, but it's a link between one system to another system. And maybe that's the progression of software next, where businesses, and an example of this is for example, let's say you need to verify someone's identity for some reason, maybe at the airport or something else. You usually see their record on your screen, and then you ask for a passport copy and you match the name, and the human being does that. So what if that you didn't need to do that? You didn't need to do that with software or the human or the human operator. What if the person who's coming in, whose identity was supposed to be matched, would just scan their passport, and a record would automatically link the name of the passport to what exists in the database, and an API would say, yes, this person is passed. You don't have to talk to anybody else. I mean, that's the future we might be living in, and that means software company, we need to deliver their service in a different way.
Okay. Well, a question came in while you were answering about, are there any actual go-to sources that you look to beyond the founders for microtrends, like any thought leadership that you regularly tune into?
There's so many resources nowadays on the web. Like, you just scroll on Twitter, follow a few. VCs tend to be very good about calling trends early. So I just follow a bunch of them and see what they're talking about. And most VCs usually take their ideas from other VCs anyway. So, or other founders, but the source of the truth tends to be the founder. They've come up with an idea or interesting idea, and I think investors tend to be very loquacious, almost like high school. You take something up, and that basically you learn something in a meeting, and you turn that into and you don't quite say that you learned something in a meeting. You say, I have a thesis, and then you push it out on Twitter, and then people think you're a thought leader. Usually how it works, but there are a number of great accounts to follow, great VCs who have put in a lot of thought and effort into their blogs, a whole host of founders, especially founders who are working on cutting edge stuff like Twilio, Snowflake, and a host of others, just seeing what they're saying. They're probably, the thing to look for is that at some of the largest companies, there are engineers and product managers and salespeople working on next generation stuff. They're working on things that they are seeing as a result of having access to data and behaviors and patterns that no one else is seeing. And they're actually implementing those ideas. And the rest of us will learn about it many, many years later. So it's like, they are probably the sad part is they don't really publish all that much. So you have to kind of rely on investors, angel investors, and founders who are willing to chat. And Twitter is a great place, whether it's podcast or blogs or just tweets themselves. There's so many ideas floating around.
Oh, that's great. I'm glad that Twitter is still source for you. We have time for one more question. Lydia's been really patient. So, you were at Twitter, you knew nothing about VC, but you ended up at a VC dinner and met Gaurav. And so she's curious, and I'm also curious, like, what are you considering to be best practices for getting connected with limited partners and building relationships there? And then a follow-on question, what's the cadence of fundraising between Fund 1 to Fund 2 to Fund 3? Like, is it getting easier? Are you going back to the same LPs? That's what I'm assuming that question refers to. But
the first question is really interesting, which is like, how do you get started? The hardest part of starting anything is just starting. And right now, if you're starting a company, you have an amazing amount of resource, whether it's accelerators like YC or AngelList, where you can raise money, or VCs who are actively marketing themselves. So you know who to talk to, how to pitch them, what to pitch, and finding co-founders. It feels like there are a number of resources available. Sort of the knowledge gap is very, very limited. But when you're raising a fund, you don't have the same level of support. You don't have the same level of information. And today that seems to be very much tribal knowledge. You ask another friend who asks another friend to figure out how did they get started, and so on. Slowly, I think we're beginning to see some change. In fact, we are doing a few things in that way. We run this program called Angel to Fund Manager, easy to search, where we take a group of folks who are angels today, but they want to start a fund. And we guide them through that process over a 6-week period with 5 or so modules where we bring in some speakers in a case study format that tells them how to get started. And when I was starting in 2012 or so, the only way to get a job in venture is to interview at very, very large venture funds. You had to kiss the ring and meet all the partners over a 6-month period, and then kind of do that, and you don't know where you stand. But if you want to raise a fund, or if you want to become a VC in 2020, start your own. AngelList has made that possible. A whole host of other LPs are far more willing to invest in Fund 1 emerging managers than ever before. And I think the bar, the friction point will drop even more over time. We're certainly playing a role, and I think a whole host of other people are too. And in terms of cadence, cadence is an interesting one. Usually funds are a 3-year cycle. So you raise money, you invest in 3 years, and then before maybe you're year out of raising, maybe you start talking to folks about the second year mark. Typically that's the way we've done it for the first. Well, we've only sort of fundraised twice, Fund 1 and Fund 2, and then I'm expecting that cadence to be there. There are other funds who have been around longer, who have an amazing track record, lots of history, where LPs are just dying to get into. They can fundraise with an email whenever they want, and some others still are able to lock up capital years in advance of them actually investing. But I think for the majority of us, it's we have to build relationships from scratch, generate really good performance. And then usually it's the same investors who invest in multiple funds. That's usually what you want, is you want continuity. Find a great investor, whether it's a family office or a fund of funds or an institutional investor, or even a high net worth. And then hopefully they will support you throughout a long 10, 20, 30-year cycle, even longer.
Well, that's great. Thank you so much, Anamitra, for taking the time to share your wisdom and expertise and experience with all of us today.